Hey everybody, hope everyone is doing well. So this is going to be another Q&A similar to last Saturday. And the goal of these Q&As is obviously in the trading room, there's questions answered, but that is really a review of what the market's doing. And it's hard at times to really give a lot of focus to questions when by the way, I've got my trade station, the screen you're seeing is on this side and StreamYard's on this side. So you'll see me look back and forth, but it's hard to answer all the questions at times when during the trading room. So part of my goal with the Q&A is time to answer questions, talk about the trading course, and what are those things after market hours, if you will, that people want answered. So with that said, I'm going to scroll through some of the comments and let's get started. This is an interesting question. So, how do algos and institutional traders trade? Are they looking for patterns or price levels, etc.? You know, for one, we've listened to Al, we've heard Al say numerous times that institutions are trading for every conceivable reason. And I think that's true. And they are using price action, they're using data points, they're using all sorts of things. A lot of traders, one of the ways, there's a couple ways you can look at that. One is if you look at enough charts, I remember looking at, for example, GameStop, so GME. And if we go back to, let me just see if I bet I can just pull it up right now. This is probably worth seeing. If we go to GameStop on a monthly chart, everyone remembers this crazy rally right here. And this was January of 21. So 1/30 of 21. I want to go to a daily chart. Give me just 1 second. Let me get a sip of water real quick. And thanks everyone for being patient today. I was trying to rest my voice a little bit. Sometimes I get tired after talking in the trading room, and I was trying to give it 20 or 30 minutes. But anyways, I remember looking at this chart, and let's say, even right here, let's look at this. So this is a great example. And it's really hard to see, but if you can see the data window of this day right here, this was January the 13th of 2021. And the data window, let me get it out of the way so everyone can see it. By the way, if the quality is poor, go ahead and you can change the settings on the laptop and make the quality better in the YouTube settings. Anyways, this is January 13th. There were 578 million shares traded in one day. The prior day had 28 million. Do you think that's and it always kind of makes me laugh about the Reddit traders talking about how, Reddit beat Wall Street. Sure, maybe Reddit traders caused it, but this is institutional trading. You're not getting 578 million shares is institutions. And if we go to this day on a 5-minute chart, 1/13 of 21, what we'll notice is this right here. If it'll let me, let's let this load really quick. Looks like any other day. But let's look at the volume of the 5-minute chart. This bar right here, the up volume and the down volume, let's call it about a million shares, 9,990,000 at the end of the day. Bar one here had a little over about 1.3 million. But what's interesting is bar two had an extra million. It had almost 2 million shares. So the average bar, here's the open of the prior day, 1.2 million. You went from a million point, let's say 4 to a 1.9 million. On the next bar, you had about 3.8 million. And then on the very next bar, And anyways, you can see this bar had 9 million shares. Do you think this is in the span of 9:35 to 10:10 Central Time? Do you think in the span of, let's say, 30 minutes, all the retail traders could figure this out? No. So you have algorithms, institutional algorithms, all sorts of conceivable things scanning for volatility in the market. Now, back to your question. Anyways, that was an interesting chart, just how much volume was picked up on this day. But back to your question about how do institutions trade? They trade support and resistance, line charts. They're looking at all the things we're talking about, and there's various ways to trade. But if you really go back and you look at pick a day, pick a random day, pick a random market, pick a 1 minute chart, pick a 30-second chart, you will see that all of the price action is the same. And there's the argument that computers and algorithms will extinct human traders, and it's really a flawed opinion. On one hand, if there's more computer algorithms trading and there's more volume being generated, then the bid ask spread is going to be smaller. That's a good thing. But all it's going to do, if you really think about it, if more and more algorithms are taking trades, it's just going to make things more precise and driven by data points. So overall, I wouldn't worry about it too much. What I would take away from this question is this right here. On any bar of any market that you can think of that's worth trading, anything listed on the NASDAQ, the stock exchange, anything that's not a penny stock, in other words, something that's highly liquid, you're going to see if there's always going to be a conceivable reason to buy or sell at any given point. So if a bull's looking to buy up here, the bears have a reason to sell. And I remember one time Al in the trading room, someone asked Al about mathematicians and their edge. He basically said, can I write an algorithm and beat the market? And by the way, before I answer this, I have seen, I know people that have written algorithms, and they're they're retail traders, and they work extremely well, and they are very, very good price action traders. So I'm not saying algorithms don't work or indicators don't work, but the fact that they anyways, the whole point with the conversation is the one thing Al made the comment on about most people compared to institutions is the difference between me and an institution, or this person asking a question in an institution, is institutions pay mathematicians multiple six figures a year to write algorithms. Al said that let me get a sip of water really quick. Anyways, Al said that he studied mathematics in college, and one of the things he mentioned was he highly considered becoming a mathematician and working on Wall Street. And he said the reason was if you're a mathematician, and you're a good one, you're almost guaranteed, multiple six figures to sit in a room and write algorithms, write code. And institutions have hundreds of people writing algorithms. So for the average person, most people are going to be better off visually learning how to read price action. But I would remember that traders are trading for every conceivable reason. So let's look at some more questions. Someone asked, I know you said that you don't use volume. I'm just curious why. I don't know what to make, I say that. What do I do with the information? So y- there's all sort, plenty of people look at volume. Now, on one hand, when I started, Al was the first person I ever really studied when it came to trading. And, you know, what drew me to Al was I picked up his book, and it was a blue book, and it said how to read, price action for the serious trader. I read a few chapters. It's very hard to read, but what I liked about it is there wasn't any indicators. And one of my fears with indicators when I started, really studying markets was if someone builds an indicator, what if it breaks? And my viewpoints have changed on that. But I don't want to have an indicator that someone made and not know how to use it because if it stops working, I don't know how to fix it. Anyways, Al's viewpoint about volume was you don't need it. And there's several things, we can look at all these bars and look at volume. But if we go back to GameStop, here's the 5-minute chart of GameStop. By the way, if you ever have a stock that's doing this, I would not trade it. It's not worth it. Your goal is to trade normal price action. If something is trading, if the volume is, multiple times bigger, don't do anything. But if I look at this bar, consecutive bull bars, if we're ignoring everything else by the close, breakout, second leg, third leg, obviously parabolic, you just don't need volume. And I could look at the E-mini today. What do I do with the volume? So this bar has 37,000 contracts. What do I do with it? Do I buy it? Do I sell it? Do I say it's a sell vacuum, a buy vacuum? I'm not discounting the importance of volume, but what I am discounting is I can look at the chart. And the other problem is, what if I want to trade Forex? So let's go to a Forex market for a minute. Here's a 240-minute chart of the dollar yen. How do I trade the volume? There is no volume because there's no centralized exchange. But these bars are more than tradable. So for me, I just don't use volume because there's plenty of price action things that I can look at to I can look at the bars. This is a big bear breakout type bull channel. And for those that were at the Q&A last week, I mentioned how whenever you get a downside breakout in a relatively tight channel, it starts the evolution of a trading range. So here is a pullback. Safe to assume strong enough downside move, probably sellers above. We go above the bar and then we sell off. And now we're in a large trading range. And now the market's in breakout mode. I don't need to look at volume to understand that. So let's look at some more questions. I'm going to turn the screen off and check a setting really quick. So give me just one moment. Okay, it's working just fine. By the way, well, let me answer this question. Okay, here's a question. Any suggestions for progressing from reading price action, developing a system with rules? Example, micro double top at top of a wedge, bull bar after wedge bottom, stop loss. Yeah, so how do you build a trading system? That is you know, I think there's two things. One, give me 1 second here. The first thing I would start with is, as far as I would start with something like always in. So you mentioned a system with rules. You mentioned, I believe you said micro double top. So you've mentioned a pattern. So you mentioned a pattern. You've mentioned a signal bar, wedge bottom, stop loss. So what I would start with is the market cycle. How are you going to identify the market cycle? And I've mentioned several times, I'm a big fan of flow charts. So for example, one thing I always do is if you've listened to me long enough, you hear me talk a lot about always in. So let's go to today since that's the most relevant for most people. When a situation like this, what I'm always looking at, and there's an encyclopedia of webinar that's on the Brooks Trading course, and I talked about a binary decision tree, and I'll try and pull it up here in a few. But the first thing I look at is always in. I'm always thinking about the market cycle. Is the market in a trend? Is it in a trading range? And right here, I'm going to scoot this chart up so everyone can see it. At this point, we're in a trading range. We gap down. We have a strong bull bar. We're probably always in long. It's a strong enough breakout for a second leg. And with that information, I'm going to look to buy and buy lower. But as far as there's a lot I could say to answer your question, but the first thing I would start with is how would you decide on the market cycle? And one of the things, as far as wedges and micro double tops, I would start with is in general, most traders first legs, in other words, a breakout that's strong enough for a second leg. This is a breakout and it reset the count. So it's leg one. Leg ones almost always have a leg two. Give me just a second. Leg ones almost always have leg two. There's like a 90% chance you're going to get a second leg after a breakout. But here, once you have one, two, maybe three legs up or three legs up here, the probability diminishes greatly for a fourth or a fifth leg. So in general, one thing I would write down is I would not trade third legs of moves because generally speaking, the market's in a trading range and leg threes will typically fail. So let me look at some more. So I don't know if that's really helpful for your question, but I would start with the market cycle. Let's see. Here's a good question. Can you explain negative gaps? I sort of get it, but not completely. I think it's like a weak trend, or I think it's like a weak trend, or we're in a trading range. I view gaps from the standpoint of how easy is it for traders to make money. And by traders, I mean limit order traders. So let me pull up. So let's take a look. Better yet, give me 1 second. Here we go. So let's take a look at let me pull up a PowerPoint slide. So can you explain what a negative gap is? Well, first off, we got to explain what a gap is. And a gap is a thin area from price. So here's a bear bar and here's a big bull bar. Let's make it bigger so we can see it. Here's a bear bar. Here's a bear bar. And then we have a big bull bar. And what you see is none of these bars are overlapping. And because of that, it's virtually impossible to sell above a bar and make money. It's nearly impossible. And that traps all the traders to the left. But over here, traders, like right here, traders are starting to make money. It's not very clear, but they are. If I remove your question so we can see down here, you can see right here, you had traders buying at a new low during this bar. And guess what? They made money. And typically, when limit order traders are making money, it increases the chances that stop order traders are going to make money and the market's going to transition into a trading range. This is traditionally a gap closing. The market went far above this low. Now, other times we talk about negative gaps. So, what is a negative gap? A negative gap is where price overlaps. So we can see right here. Here's the highs of these bars right here. And if I draw a line, you can see this gap closed. But the point with negative gaps is you had a very short window to avoid a loss. And that's assuming you got out at this high tick. What if you got out right here? it's still closed. But what if you got out at this close? It touched it. And if we pull up this day, August the 8th, on a line chart, here's August 8th, here's that gap. I'm going to draw a box so we can just find it quickly. Let's go to a line chart. What do you notice? So what do you notice about here to there? The gap's open, and it's clearly open. So what this causes, this is basically how negative gaps work. You have institutions who use closes, not necessarily candlesticks. And the way I view it, even right here, this gap closed, that's true. But look how difficult it was to make money. It went once or twice below the closes, but not very low below the closes. So that's how I view gaps. I think about gaps as how easy, realistically, how easy is it to make money if I am trading with limit orders? If it's very easy, then it's obviously a trading range. So, like today, you have traders selling above bars, making money, buying below bars, making money over here. The bulls that bought this low right here, scaled in lower, they made money. Trading ranges are forgiving. Unlike a few days ago, let's say right here, this is very unforgiving for limit order traders. And these gaps are very much open, but these gaps are definitely closing. So I think about how easy can limit order traders make money. Question, we've had a lot of broad stop order trading ranges over the past few weeks or so. But in these big reversal days, if you look to scale in, you just get killed. Any advice? Yeah, well, limit order traders, when you think about big reversal days, let's go to example. Like let's look right here. So let's say a trader, I don't know, let's say they sold, let me move this chart up. Let's say they sold somewhere down here. And I don't know, you sold the high of this bear bar and you said you're going to scale in. You sell, you scale in here, and you make money. And you think, yeah, we're in a trading range, so I'm just going to do it all the way up. You sell here, you scale in, you had a chance to get out, chance to get out. And if you got out, you made money, or you at least broke even. But here's the problem. What happens if you sold the high of this bar right here? Well, there's a couple of things wrong. One, it's a wedge bear flag, and we got a bull breakout of the bear flag. But the other problem is when you get a strong breakout, your premise has changed. So, Ace, what I would say to your question is you mentioned how on big reversal days, if you scale in, you get killed. Well, big reversal days imply a big reversal, and your premise is likely changed. So if I'm selling, I'm betting on a trading range, let's say, I've got to have an idea of what is wrong. For me, it's usually consecutive strong trend bars. And even this, for me, if I'm selling, I'm not scaling in all the way up. For one, I see limit order trading as basically this. So let's go to it today. Let's go to today, for example. Today was a good day for limit order trades. For me, limit order trading is if I'm buying the 8 low and getting out around the midpoint, or selling above 13, betting on a trading range and getting out on reversal down. If I'm buying, I talked about this in the trading room quite a bit. If I'm buying below a bar, let's say 28 this low, the way I'm trading with limit orders is I'm buying that low. Maybe my stop is a measured move down and I'm getting out quickly. So I'm buying the low of this bar. I want to make a scalp within 1 or 2 bars. I'm not going to buy, and there's a big bear bar on the next bar. I'll just get out. I talked about that over here on the trading room on bar 37. If I bought this low, which I would not, if I did buy this low and scale in lower, then if I see this bar, I'm going to be pretty quick to just take the loss. And the reason is I would rather wait and see the market bottom than exit. So one of the ways I think about limit orders, I'm always thinking about always in trading. So I never want to be, let me see if I can pull up this flow chart really quick. Give me just one moment. So anyways, where I'm getting at is on a day like here, if I'm buying any of these lows and then I get a strong breakout on 17 and 18, I don't want to be long when there's a strong breakout. In other words, I don't want to buy when I think there's going to be a second leg down. So if I'm buying based on the market cycle, remember, I'm going to turn the screen off and pull up the flow chart. It'll just take 1 second. So here's an example from the webinar that we did. I'm always thinking in terms of a decision tree. Is the market in a trend or in a trading range? Trend, is it in a breakout or a channel? If the channel's tight, only trade in the direction of the channel. So if we take this chart right here, what I will do is I'm going to go to this day. This is a tight trading range. If I'm doing anything, I'm trading with limit orders. But then we get 16 and 17, strong bear breakout with follow through, and then more follow through on 18. This is a breakout. I'm going to go back to my decision tree. It's a trend over here. It's a breakout, and it's pretty strong. So I may enter at the market, but there's no option for me to fade the breakout. The other thing I think about is legs. This is a strong enough breakout that we're no longer in a trading range and we're in a breakout. So I'm expecting at least one or at least a second leg and maybe a third leg. There's a second leg down. The next thing I look for is I'm looking for signs of strength. So for me, here there's nothing I can do to fade this move. And it doesn't matter. It doesn't matter if I bought up here, it doesn't matter if I bought here, or if I'm thinking about buying at the market. If if I get a breakout of a trading range and I'm long, it's an invalid, my premise is no longer there. So scaling in is not a factor. The only choice I have is either getting short or being flat. So I hope I'm answering your question there. Let me take a look at some more. I'm scrolling through right now. Okay, so is it possible to scale in by having two different trades at the same time with different entry prices and stop loss? NinjaTrader combines my trades, moving my entry price, but can they exit separately? Well, yeah, I mean, technically, for you have a cost basis, or better yet, an average price. So if you buy, without going into too much detail, if you buy down here and then you also buy again up here, your average price is going to be in the middle. So on NinjaTrader, any platform, it's usually going to show you what the break even price is before commission. Now, the way I look at it is I'm always thinking in terms of, I think of a trade as a whole. So if I'm short and I add to my position, or I'm short and I scale in, to me, I always think about risk from the market price to my stop. So if I sold the open, this is not free money all the way down here. That's one thing that I think that's kind of interesting about these online prop firms like Apex, or I forget all the others. There's Top Trader, or one of those. Anyways, what I think is interesting about them, a lot of them have something called a trailing drawdown. And what it means is they view your account balance from the high tick to a pullback. So your drawdown, even if you bought down here, if you let the market go all the way up here and then go all the way back to your entry price, that's a drawdown. And I think that's actually a good thing. It makes it more difficult for traders to pass them, but it makes traders think about the market the right way. If you bought down here and you give up a profit, let's say you were long all the way up here, so you have a big open profit and you held overnight and you lost it, then you lost what you made. And I view that the same thing as scaling in. So for me, I think about if I'm selling and scaling in, it's all the same trade. How do you identify legs? It seems like there's multiple ways to look at it. Yeah, for me, you can count legs as this is an easy one. A lot of traders, traditionally, traders will look at legs in terms of we have a bear. For one, I'm always thinking about the market cycle and something to reset the leg count. In a situation like this, we have a tight trading range from 3 to 15. When there's a breakout, strong breakout and follow through, and I look at it and say, yeah, that's a surprise. This is a bear breakout. That makes me think it's the market cycle's over. So this is now leg one. We have, you could argue, this is what's kind of a little bit implied. This is a pullback on a lower time frame, but it did not trigger on this time frame. So some traders will say this whole thing is leg one, and that's fine. I like to view it as, hey, that's a strong breakout. This is a pause, and that's a strong bear breakout. And you can argue that, oh, this breakout reset the count. But I like to think about it as consecutive climaxes. Every breakout is a climax. This strong enough rally that it broke this sell off, and then we have a third leg down. But even if you said this reset the count, pull back, that's a second leg. Guess what? At some point, you have to decide it's not a second leg. So here, 1, 2, 3. There's several other examples. Today, how do I view it? We rallied, and then a pullback. We went below a prior bar. We had a strong upside breakout, and then we went below a prior bar. So that's the second leg. Then we have a third leg. That is how I generally view leg counting. And there's also a lot of things that are implied, like this breakout to 36. That's the first leg. It broke out below price action. We pulled back, and we got a second leg. So I hope that's helpful. Don McAllister asked, what kind of microchannel characteristics do you look for, and where do you place limit orders to buy, anticipating a second leg? That is a really good question. Microchannel. So let's start with a few things. Let me get a sip of water really quick. So a microchannel, in order to trade microchannels, you got to think about what a microchannel is. A microchannel is a breakout on a higher time frame. I'm going to pull up something on my screen really quick. So let's look at, let me pull up here. I reference this in the trading room pretty regularly. This is a microchannel. Now, this is probably one of the strongest types of breakouts or microchannels you can get. And the way I view microchannels, I'm thinking about pullbacks. How deep are the pullbacks? So if I'm buying, if I want to get long and every pullback is, maybe one or two ticks, and we keep going higher, obviously I got to get long. So one of the things you can do is trade something really small. So trade the SPY, trade one micro, have a way to just be able to enter at the market. Now this is very different. Now, how do I differentiate? The main thing you have to think about is, okay, well, how do I differentiate this chart from today? Because if you just buy this third bull bar up here, you get a deep pullback. Yes. So what I view, I'm always thinking about limit orders and stop orders. How easy can limit order traders make money? How easy can stop order traders make money? It's really important to, and I don't want to go off topic here, Don, but I need to explain this one thing to get back to your question. It's really important to understand limit order trading. And why is that? It's important to understand how limit order traders get trapped. And, kind of the joke with that is if you start trading with limit orders, start buying below bars, selling above bars, you'll make money. And someone mentioned, I remember there was someone in the, I don't remember who, or anyways, someone mentioned they bought and they just kept scaling in lower and they finally were able to get out break even. That's a very dangerous thing to do. But what they're learning by taking that strategy, there's one thing that person understands. They understand that if they scale in repeatedly, they'll probably worst case break even. Now, the one flaw in that is the one time you lose, you risk severely damaging or ruining your account. However, if that trader in particular could learn to evolve, in other words, they buy below this bar, scale in, scalp out, they buy this low, scalp out, they buy this low, and then they sense they get trapped, they can reverse positions. So let's look at an example here. This is my second favorite chart I often show. So Don is asking, how do you identify strong micro channels? Or let's go back to your question, Don. What kind of micro channel characteristics do you look for, and where do you place limit orders to buy, anticipating for a second leg? So let's just scratch the buy word and say, where do you place limit orders to sell, to go short, anticipating a second leg down? And let's think about this chart. Here is a bear bar, and here's a very strong downside breakout. And the one thing you'll recognize with this chart is you have all sorts of limit order traders getting trapped. So for me, if I'm deciding how do I get in the market, I'm looking, intensely at the limit order traders, the counter trend traders. So if I see a bear breakout, I want to see how screwed, for lack of words, are the bulls getting. If you're a bull and you're buying below a bar, are you just getting, completely annihilated? And if you're buying this low right here and you buy more lower and you buy more lower, where are you getting? This is a 1 minute chart, by the way. So this is a 1 minute chart, this box of this sell off. Where can you avoid a loss? If you bought this low, 1 point lower, 2 points lower, you're going to take an amazingly huge drawdown. Look for 1, 2, 3, 4, 5, 6, 7, 8 bars in a row on a 1 minute chart where you had a tail that was maybe the size of 1 or 2 ticks. If you're buying in any fashion on the way down, you're going to lose money. Okay. So let's think about the opposite of that. If there's a situation where, hey, if I buy here, I'm going to get killed. Okay. So what does that mean if I sell? If I sell anywhere at the market, it doesn't matter. I can just close my eyes and, just hit sell the market. I'll probably make money. That is an extremely strong trend. Down here, if you sold this bar, you sold the high of this bar, and then you see this bull bar, you're in a lot of trouble. And if you don't get out quickly, you're going to face a ton of pain. We saw that over the past couple of weeks, or really past couple of days. We had big sell climax, another one, big bear breakout, another one. And Don, back to your question right here. The first thing I identify is, and Don, please comment if this doesn't make any sense. The first thing I identify is how trapped are traders. So when I see a bull bar and a second big bull bar, I'm thinking to myself, hey, there's a negative gap right here. And bears are having a hard time selling above bars. That's pretty strong. If I was short, I would definitely be out of shorts. And one thing I always ask myself is, if I'm short, if I'd do anything at the market right now, if I had to buy or sell, what would I do? And if I look at the market and say, heck, there's no way I'd be short right now, and I'm short, that's a big problem. So obviously the first thing is trapped traders. But what about today? This is more difficult. But on a day like today, I focus on limit order traders making money. So here we have a big bull bar. It's a 3-bar micro channel. And by the way, when I see strong breakouts, I want uniformity to the breakout. Big bar, another big bar. Here, 1 bar, 2 bars, 3 bars, 4 bars, but they all look about the same size. And that's really good for the bulls. And that means probably going to go higher. Here, this is climactic behavior. One thing to mention, by the way, is strong, small pullback trends. The best breakouts or the best micro channels are not climactic. I mean, a micro channel is climactic in and of itself, but the ones that have bull bars that are average size that keep going up, they can last a lot longer. And a small pullback trend, here's a small pullback trend. It is the opposite of a climactic move. It becomes climactic through time, but a trading range becomes climactic almost immediately. You rally, and then you have this bi-vacuum test of resistance above. And the climax is it's a vacuum effect. And if you get a vacuum effect in a move, nobody's going to hold on to their profits. So here's a 3-bar micro channel. And when I'm looking to trade, one of the things I do in trading range is I'm always anticipating deeper pullbacks and disappointment. So if I'm buying right here, I see open gaps. I might buy a small position just in case we go higher, but I'm going to be pretty quick to scalp out. And we have a breakout. We'll probably get a second leg. I'll probably look to buy a pullback of some degree. So maybe buy below that bar. Here's a micro channel, but it's parabolic. So I'm not going to be so quick to buy there. My 3 consecutive bear bars, I'm willing to sell for a second leg. Here is a 3 or 4 bar micro channel, but it's 2 legs down in a trading range. I'm going to be a lot more cautious about selling. I might sell above a bar for a scalp. So it really depends on the first thing I'm identifying with micro channels and second legs is I am looking at the context first and the leg count. So here's a follow-up. He says, that's helpful. Thanks. I'm trying to differentiate between good micro channels that have higher probability of second legs. Looking at how screwed limit order traders are is helpful. Yeah. So that gets into limit order trading or leg counting. A breakout, typically breakouts have 2 or 3 legs and then they fail because most breakouts are in a trading range. Very few breakouts are in this context where you get a big sell-off and then it has several legs down. Most breakouts are in this context. You break out, you start to go sideways for 10, 15 bars, and then you reverse up. I'm always thinking in trading ranges, I'm looking for a sudden change. So what I want to see is 2 or 3 legs down. Here's leg 1, leg 2, leg 3, and then we have a breakout. Now, this breakout is testing resistance up above. Now it's a 3-bar micro channel, but there's tails above and tails above. What I'll often do in these situations, and what I did today, I'll buy below this bar, and I'll get out around the midpoint of the bar. So I'll buy the 32 low, for example, and get out around the midpoint of the bar for a scalp. It's a micro channel. It's probably going to have a second leg. Here, 3 bars down on 36. It's going to have a second leg. The key, to answer your question, Don, in a trading range market, micro channels that are parts of leg 1 often have second leg, but you get a deep pullback in the middle. So if you sell early, you have to find a way to enter quickly. If you sell early, you have to have a way to scale in. How do you identify which direction the market will go? You do use the market cycle. You have to understand the video course. On those straight down days, I look for reversals, usually too early. What's a better entry? I'm assuming you're talking about these days right here. So the way I view these kind of days, I actually drew a chart on this that might be helpful. Let me pull it up. Here it is. So let's talk about it. This day was yesterday, and I'm going to hide myself so we can see this. Type bear channel breakout on a higher time frame, and we have this rally, and then we get this sudden downside breakout right here. This breakout reset everything, so it's now a bear breakout, and it can go on a long way. And then we have limit order traders making money, bulls buying this low, scaling in lower, making money. That starts to evolve the market into a trading range. Here, bulls making money above bars right here on this box, which corresponds to this right here. So consecutive bull bars right here, but no closes below the EMA, minor reversal, but probably transitioning into a trading range or a broad bear channel soon. So probably transitioning into a trading range from a bear trend. Expect buyers below or at a new low, scaling in lower. But what do you notice about this red box? This changed this reset everything. So this is a new breakout that went down for a little bit. And then we had all these traders making money up here. That transitions the market into a trading range for the rest of the day. So let's look at the actual chart. What I'm always looking for and here's another example that you might find helpful. What I'm always looking for in a small pullback trend, I'm looking for signs of strength. I want to see a strong upside breakout that completely just damages the case for. I'm always looking for a strong breakout that damages the case for a small pullback trend. So here's an example from a couple of weeks ago. We had this very strong sell-off, and what we can see is we had a small pullback trend, but what do you notice right here? You had bulls making money above bars. Right here at this low, you had limit order bulls making money below bars right here. And if you go back to the video course, limit order traders making money below bars increases the market, the chance that the stop order traders will make money. When stop order traders begin to make money, the market's in a trading range. So in this situation, the one thing I don't want to do is buy until I start to see clarity in bulls making money in this case. Look at the bears. The best the bulls can do is have a bar go above a prior bar. Even here, we have this strong downside breakout. Sure, the bulls were able to make, 1 or 2 points above this bar right here, but it's following two really big bear bars. It's a measuring gap. Then we get a sell-off here and here, but bulls made money. You see this box? This box corresponds over here. This corresponds to right here. This is how much lower the market went, which is this blue box. But what you'll notice is right here, we rallied all the way back to the trading range. So one thing you can do is, back to your question, on these straight down days, I look for reversals, but I enter too early. Wait for stop entry traders to make money. It's really common for trends to take a very long time before they reverse. Strong buying, strong buying, strong buying. Even here, big sell-off, sideways, sell-off, more sideways, and then even more sideways here. I know it's hard to see, so let me scoot this up. So anyways, I would wait a little bit longer because, by the way, as far as picking bottoms or tops, if you're buying and scaling in, this is the risk you face. And if you're buying aggressively and you're one of those people that you move your stop pretty regularly and you can't take the loss, imagine holding through this. You could just get totally wiped out. But if you were talking about if you were to look for bulls to make money on a stop entry, let's do that. So, okay, it's always in short maybe, but not clear. Now we have a breakout. So it's always in short. But we have bulls making money. That's good. But I want to see, since I'm looking to buy on stop entries, I want to see stop order bulls make money. We broke strongly on the downside. Bulls aren't making money above stop entries. Still not making money. Sideways, but still not making money all the way to the end of the day. And same thing over here. If I'm a bear, I'm going to wait. If I'm looking to sell, the only thing I might do is sell with limit orders, but those are very short trades. Until then, the only thing I'm doing, I want to see bears make money below bars. Otherwise, I'm not doing anything here. And obviously, it took forever. Now, what about over here? Let's say I'm short, so I'm selling breakouts. If this is a trading range, I want to be very careful about selling low. But let's say I did. Let's say I sold this close. And then we see this big bull bar. I look at that and I think, gee, stop order bulls, they're making money. That's a pretty strong bar. Maybe I should get out and wait for a small second leg up. And then obviously it reversed. Sandro asked, hey, Brad, are there days where you choose to be flat? If so, why? Or are you always trying to take trades on a daily basis? When do you stop trading? Do you have personal rules for that? You know, I don't know. For me, I'm always, I generally trade every day. And for one, kind of the way I see it, I think there's nothing wrong with with having personal goals or personal rules. As far as when do you stop trading, obviously, if you have several losing trades, you have to have a way to protect your account. And if you're taking a lot of if you're losing a lot in a row consecutively, it's always better to stop. But if you can trade really small, you can trade all day. One of the benefits for me, I like trading most of the day. And, I'll typically, it's pretty common. I mean, I'll take at least 10 trades in a day. That's pretty common. More if you include scaling in for sure. But I like placing trades. And the second thing is I think there's a benefit to learning from experience. So, if you want to get good at anything, golf, you have to play golf. If you want to, get better at trading, you have to trade. But you have to do it in a smart way. You have to learn from mistakes, and that's very important. But as far as do I trade generally every day? Yes. Searching through more questions right now. Tom asks, Brad, can you give a mini lesson on high ones, high twos, low ones, low twos, bar counting, pullbacks? Yeah. So the first thing I'm always thinking about, as I've said several times, the market cycle. And let's just go back to, I don't know, we're going to pick a random time. 2/2/22. Something just totally random. And by the way, I like to do that pretty regularly. I like to just pick random, months, years, and just look at charts. So, anyways, let's go to, I don't know, let's just go to here. And okay, so a mini lesson on high ones, high twos, low ones, low twos. So the first thing I'm looking for is context. We have a gap down, and the one thing I'm looking for on the open, you hear me say it all the time, don't take trades for the first 6 to 12 bars. Wait for something strong, strong breakout, strong follow through. 50% chance the first breakout will fail. And if I'm thinking through that, then one thing I'm going to do is I'm going to look at, I'm going to try and find a, I'm going to try and find, let's say, a breakout. Here's a breakout. Are we always in short? Yes, but I want to see follow through, bad follow through, 3 legs down. So leg counting, I count every tail. let me back up. When you get a sell off and a rally, sell off and a rally, sell off, rally, that's a wedge. That's 3 pushes down. Sold off, pulled back, sold off, pulled back, sold off, pulled back. And if you get 3 legs down, you have a wedge. So why does that matter? Because typically, if the market tries to do something 3 times, sell off, rally, sell off, rally, sell off, rally, then it's going to try to have a couple of legs in the opposite direction. So if I'm short, I'm getting out above that bar. We rallied up to here. That's a strong enough breakout for a second leg. There's a pullback. And did we get a second leg? On this chart, we didn't. Now, this is the challenge with leg counting without being really confusing. You see this tail on this bar right here and here? Guess what? This market, if you bought on the way up, you probably, let's say you bought and the market rallied and pulled back, you could have gotten out pretty close to break even. So this bar rallied, pulled back, rallied again. That's a second leg. But maybe we broke out here, we pulled back, and we're going to get a second leg up now. Maybe that's a second leg. Here, we have a trading range. 1, 2, maybe 3 legs down. But one thing I'm thinking about in a trading range is whenever you have something that's tight, that's channeling in one direction on the open, I'm always thinking about, is it a small pullback trend? So small pullback trends, if we remember, the difference between a small pullback trend and a trading range is gaps. That might be a gap. But then the gap closed. So 1, 2, 3. Now it's a more clear wedge. Whenever you're looking at wedges, there's a lot of ways to draw wedges. And in this case, here's a first, here's a second, here's a third. Now, tight bear channel. And a lot of traders want to see a strong trend line break. So the first thing as far as bar counting, step 1 that I would write down is in tight trading ranges, there's going to be multiple ways to count legs. That's why it's really difficult for traders to count legs in tight trading ranges is there's several ways you can identify the leg counts, but I'm going to scroll until we find something strong. So I want to find, when I say strong, I want to see a sudden, let's look at something like this. Let's say this is a breakout, right? So there's the first leg, pullback. Most people include, so a breakout is the market going above the prior bar or below the prior bar. And when you get a breakout, some people count legs as price going below the breakout or below a bar. That's a trend line break. It's a pullback. And then we got a second leg up. However, trading ranges have nested patterns. And, I know leg counting is going to sound frustrating. The problem with leg counting is, it's kind of like this. You have to watch the video course over channels because I said this was leg 1, but channels, the first leg can often be this leg. Why is that? Because sometimes you get a breakout right here, consecutive bull bars, then you get a new low right here. So you get a breakout, and this sell-off is a pullback from the breakout that gets a second leg, and then a third leg. So it's possible that this whole thing right here is a wedge. 1, 2, 3. Then we have a bear bar closing on its low. So for me, whenever I'm trading in trading ranges or I'm looking at a channel, I'm always thinking, okay, I'm buying. I know this is a tight bear channel and I could get trapped. So if I'm buying right here, Tom says 2 trends at the same time. Yeah, I like that. A trading range is 2 trends at the same time. That's how the market starts to go sideways. And you have to think about it that way. So here, if I'm long and then, if I don't get out there and then I see this, I'm definitely getting out because there's too much risk. It's 2 or 3 legs up and we sell off. Bear bar and then a bull bar. So what is this right here? We sold off, we paused, we sold off again. That could be a 2-legged pullback, but it's a micro channel at the same time. So we may go a little bit lower. And instead, we got a third leg down. and then this is open gaps. So let's find a better, trying to scroll and find something a little bit more clear. This is a great example. Leg counting is always more clear in strong trends than trading ranges. Consecutive bear bars after a gap, but I'm going to scroll up because I want to see this right here. Big bull bar, another big bar. This is a strong enough breakout for probably to be a first leg. There's a pause. We went below a prior bar. And then we have 3 consecutive bear bars. That's a second leg. So we broke out, pulled back, second leg. Then we have a breakout and a bigger bar. This might have reset the whole thing. So this might be leg 1. We have a pause. That's a high 1 buy. Now, high 1s in general, in trading ranges, high 1s typically lead to deeper pullbacks. In trends, high 1s often, this is a high 1. Yes, Tom. In trends, high 1s can often trigger above and pull back to the midpoint. So sometimes it has a delayed trend resumption feel to it. And that's what happened right there. So why is this? Let me see if I can, give me 1 second. Let me see if I can do this. So here is an example. This bar right here where I'm drawing, what is that? That's a sell-off. The market went down. And what's this bull bar? It's a rally. The market rallied. So on the larger time frame, what do we have? We have a strong rally with these 2 bars from here to here. And on this time frame, this bear bar is a breakout on a smaller time frame. It increases the odds of a second leg down, which we got. And that second leg is why sometimes you get high 1s that fail, and then you get a 2-legged pullback. So I'm going to continue this. Give me about 20 seconds. I want to get a glass of water really quick because my voice is getting dry, but I do want to talk a lot more about this. So everyone give me like 20 or 30 seconds. Okay, thanks everybody for being patient with me. So, as far as counting how do you count pullbacks and high ones? The first thing is context. So here, the most important thing to realize is this is a very strong breakout. So if you're selling, there's a higher risk of getting trapped. These bars are breakouts on smaller time frames, and breakouts typically have second legs. And that's why you have a pullback, second leg. That's a high one. The high one pulled back a little bit further, and then it led to a high two. Technically, this is three pushes down. One, two. So we went down and we went up. That's a high one. We went down and we went up on this bar. That's a high two. But we also went down on this bar and then up again. That's a high three. Now, and then this count got reset. Here's a high one. We rallied, pulled back, high one. I view high ones from the standpoint of, some people call it a pivot high. We have a breakout, so it's a new pivot or a new high. We pulled back, there's a high one. But this trend is too strong. The important thing to think about with high ones and high twos is the more the trend goes up, then the deeper the pullbacks are typically going to be. So eventually you get consecutive buy climaxes and then you get a deep pullback. Now, on a day like today, a day like this, the more important thing is just to understand you enter and buy anywhere. Don't sell anywhere during this rally. And then when it becomes consecutive buy climaxes, wait to sell. But don't sell even when you see this because you still might get this. But what I'm looking for in a strong trend is something strong like a trend line break. And then that is not enough, but that's enough to make the market probably form a trading range. And there's your trading range. But today, let's go to today because that's way more important of a type of day for leg counting. In trading ranges, you get a breakout that gets a small second leg, sometimes a bigger second leg, and then the market goes sideways. Here's a bear breakout on 17, and yet a pullback on 18 and 19. So technically 19 is a low one. If you look at a smaller time frame, 18 rallied and pulled back. So that's a low one on a smaller chart. And then we rallied again and we sold off below 19. So that is technically a low two. But either way, call it a low one, doesn't really matter. You had a low one below 19, but you have a strong breakout down to 17. You're probably going to get a second leg. That's 20 and 21. Now look at this bar right here at 11. Well, at bar 23, there's probably buyers below. Why? If there's buyers below, because typically when you get a first leg and then a second leg in a trading range, the third leg usually doesn't go that far. And you can see bulls bought below this bar and scalped out. So how do you select? Okay, let's see here. So how do you select to buy between a high one or a high two or a high three? It's a great question. It, for one, is the way I select is context number one. So if we get a bear breakout like 17, well, let's use bull rallies because you're talking about high ones. So let's take bar 7. That's a strong enough bar. We're probably going to get a second leg. I'm more than happy to buy a pullback or buy above the bar because I know we're probably going to get a second leg. So I'm willing to buy above a bar like 9. But then we get 10 and 11. Okay. Now 10 and 11, we've had 3 pushes up. So there's a greater risk of reversal. I'm not buying above this bar. Now, what about here? This is a good example. We have a strong rally up to 57, but overall context, it's consecutive sell climaxes. 1, 2, 3. We have a bear bar, and then we have a bull bar. That's a high one, but it's a high one at the top right here. That's a high one in the likely early part of a trading range, and it's the first bar completely above the moving average. So there's probably more sellers above it. So one of the things about high ones is this. If I'm a bull and I bought the close of that bar, I'm disappointed by the follow through right here. And if I'm disappointed by the follow through after on 58, what do you think I'm going to do on the next bar? If I bought the close at 57 and I'm disappointed, I may get out break even after 58. So that high one right here on 59, that is traders getting out break even. Now, why would they get out break even? Because they believe that 58 is strong enough for a second leg. Here's the opposite example. Why would traders, we sold off and we rallied into the close. Why would bears exit on that bar? Because on a smaller time frame, we sold off and rallied. It's a 2-bar reversal. And that 2-bar reversal is strong enough with consecutive sell climaxes to get a second leg up. Here, that's a second leg. This breakout's strong enough to get another leg up. That tail sold off and rallied. So the breakout is a trend line break. It's kind of like right here. We have a bull bar. That bull bar is strong enough for a second leg up. There's the hesitation. That's the pause. And in other words, you could call that the low one. We have a sell off down to 29. Bulls disappointed, bears disappointed with 30. What are they going to do on 31? They're going to look to get out break even. And the reason is they believe 30 is strong enough to get a second leg. And that's why you can see right here. So this is 31. This is 32. 32 went above 30, and it's a second leg. If we look at, so anyways, I hope that makes sense. So a high one is a rally after a pullback that doesn't go quite as high as the prior rally. Yeah, that's one way to look at it. So this, you can argue, is a wedge. We paused. Let's just do it like this. We rallied and we sold off on, and we sold off on the bar. So you can argue that 8 is a high one. And then we got 9, which is a bear bar. And then 10 rallied. And then we sold off again on 11. And then it rallied. That's a wedge. 1, 2, 3. It pushes down. And it's very common. You've heard Al in the video course. And by the way, if you're listening to this and you haven't watched all the video course, it's actually, I would really suggest really focusing on the video course and then coming back to these videos because it's going to make a lot more sense. And that's why the video course is over 100 hours. But anyways, it's very common for wedges to get 3 or 4 legs, 1, 2, 3, and 4. And the reason why it often gets 4 legs is because the pullback, and sometimes people view the wedge or the pushes down differently. So maybe 9 is the first push, pause, 11 is the second, and 12 is the third. So anyways, I hope that makes sense. So let's look at some more. By the way, I focus on one chart when I'm trading. Question, are there any differences between BTC and other instruments that you need to take into account? When you say BTC, I don't know if you mean Brooks Trading Course, Bitcoin, exactly, but I'll say this. For me, this is how I view price action. Whether that's the Brooks Trading Course, I view all markets that same way. So if I'm looking at Bitcoin, it doesn't matter to me. I'm looking at BTC, Bitcoin, weekly chart. Let's go to a monthly chart. There we go. Big rally, big sell off, big rally. Why did we sell off right here above these bars? It's pretty simple. We had such a strong rally and a deep pullback. We're in a trading range. Big sell off, second leg down likely. Strong second leg, may get a third leg. And now we're in a tight trading range. So the market's deciding, are we going to test lower or go higher? I suspect we're going to be sideways for some time. But it doesn't matter to me as far as the market or whatever the chart is. So let's look at some more questions. Someone said live or sim trading's paramount, not watching videos for 6 months. Do both. Yeah, I did both. And, I would really recommend the more you study, the more you're going to learn. So you can do both, but if you don't know that you're doing something you probably shouldn't do, it can slow you down. So learning price action will allow one to really trade whatever product they like. Sure, price action is genetically based. It's just logic of looking at charts. So let's see here. And by the way, these, in the future, I'm gonna start having. I plan to start having more Q&A sessions over specific subjects, like always in. So in other words, what I really want to do is, one of the ideas is possibly in the future have a discussion over one of the videos in the course. So, for example, always in, or video, the breakouts videos. So videos over the breakouts, and then have answer questions over those breakouts. Or let me back up. I have a dog next to me that's pushing my arm. It's kind of distracting me. Anyways, one idea is we'll do a lecture over the video course. So we'll pick a video or a series, we'll talk about it, and then we'll answer questions and give examples of charts, recent charts over some of those videos. So I plan on making these Q&As more structured. Can you talk about climactic reversals? Sure. Here's a climactic reversal. We have a sell-off. Climactic reversals, most breakouts are climactic. And because of that, you have a climax leads to sideways trading. So you get a sell-off, sideways, sell-off, sideways. When you really think about it, let's go to a 5-minute chart. When you get consecutive, here we go. Consecutive climaxes increase the risk of climactic reversals. So you get a big sell-off, another big one, and then you get a bear breakout below a channel. That increases the risk of a climactic reversal. But even climactic reversals typically just lead to sideways trading. So the way I think about it is this. A climax, first, in order to understand a climactic reversal, you have to understand climactic behavior. And by the way, I'm curious to know what are in the questions. I'm curious to what would be some subjects from the video course that people want me to talk about. Like, I like this question right here. Can you talk about climactic reversals? So comment on some other topics you want me to discuss. Let me pull up. I've got a crude oil chart here somewhere. Okay, here's a great example. I'm going to move this actually to the top. So here's this chart. So here's this example. I've showed it several times. Big rally. Here's a 1-minute chart of that same breakout. And if we look at it, this chart right here, let me get rid of this question. So can we talk about climactic reversals? If we look at this chart right here, it's climactic, but it's pretty orderly. So one of the ways to think about climaxes is right here. Let me find an example. Small pullback trends. Small pullback trends like this right here can last a really long time. And the reason is it doesn't go too far too fast. Um, by the way, I'm trying to gauge some of the comments on here. So one other thing while I'm thinking about it, some people ask questions. I'm going to talk about takes steps to getting out quickly on the next discussion. Can people talk as well? Would people rather have who would like more free flow discussions like this versus an actual structured discussion over, maybe a voted topic like breakouts, second leg traps, trading ranges? I'm curious to know if people like more free flow being this, where we just kind of go with the flow and whatever questions get asked, or more of a structured classroom style discussion. Anyways, there's a chart. I'm going to pull it up real quick. Take 1 second. Have it right around here. There it is. So this is a good example of why climactic reversals happen. And it has to do with the slope of moves. So we have a rally and then a more shallow trend line. And then we get a trend line break. And then we rally. But then look, we get a steeper rally. And that causes the market to have sharp sell offs. It's not sustainable. Look at this. We rallied, pullback, steeper rally, pullback, and then an even steeper rally up to here. That causes an increased risk of a sell off. So if you draw, let's say, trends, you'll start to notice we have a bull trend right here and then a sharper rally right here. And then it gets steeper and then it gets sharper again. And the way to think about that is whenever you have a really big, let's look at an example like this big bear bar and then a follow through bar. Whenever you get big bars like this, more and more traders take profits. And if you know traders are taking profits, you'll have more traders fading and buying on the way down. When you place trades, do you use bracket orders? Yes, I use bracket orders on almost every bar. So the way I have it set up is no matter what order I enter, market order, limit order, I always have a bracket order. And I'll change it. For example, I like bracket orders. So I have let's say my default is a 1-to-1. So if I'm in one lot or one unit, I'll exit all at one price. I have a second one for maybe, it'll put a stop in and then it'll give me two limits to get filled. And I use typically either one, but I like bracket orders because one of those issues, for one, I know if I accidentally buy at the market and don't realize I've got to stop in the market. The second thing is and the other piece is if I'm long, let's say I'm short right here. Well, what if I want to put a stop in and I'm not thinking and I sell? So if I do a bracket order, that's one less decision I have to make. So for me, if I sell at the market, I have a target in, I can move my target wherever I want it. I can move my stop wherever I want. I don't have to think, okay, I'm short. Should it be a buy order? Should it be a sell order? That's one less decision I've got to make. Is it okay to not use the moving average? I think there's no problem because the important thing is the chart itself. Sure, we don't need a moving average. The only thing I like about moving averages, a moving average is a reflection of the fair price. So if we rally, if we've been away from the moving average for a lot of bars, and we start to go sideways, and then we get all the way up here, the moving average is getting further away. And because of that, it's a sign of climactic behavior. I talked about that a lot on the daily chart. We had a rally, deep pullback, sideways trading, and then we started channeling up. But then we got this big bar right here on July 27th. And I mentioned that right here, this bar was so big and we were away from the moving average for about 40 bars over here. The odds were really high. We were going to get to the moving average and go below it. But you don't need a moving average. Here, I can get rid of it. We're channeling up, a lot of overlapping bars, clearly a bull channel. Now, the one problem with not having moving averages is it's a little more difficult to see trends. If I have a moving average right here, it's pretty easy to see that the market is channeling up, but you don't need it necessarily. Bracket orders, meaning one cancels the other. Yes. Okay, someone says thanks, and I see you use TradeStation as your preferred platform. Yeah, I like TradeStation. I'm used to it. I've used a little bit of NinjaTrader, but for me, I like the TradeStation. I really like the charting on TradeStation. I know others will disagree, but it's simple. It works well. I know all the little shortcuts for it, and I like it. But TradeStation, Interactive Brokers, NinjaTrader, they're all fine. Someone says, I'd like to see a voted topic discussion with advance warning so we could watch the Brooks videos of it first, even though we've already watched it a year ago. Yeah, well, always watch videos over the video course. That's great. Yeah, that's kind of one of my thoughts is, maybe we have a weekly session over one of the videos and we vote. So, if we were going to talk about, let's say, trading the open, we'll have that might be, we'd get a week's notice where everybody would have time to watch the trading the open videos and really think about trading the open. Then we'll have an overview discussion of trading the open, look at it, maybe the past week or 2 weeks of opens, discuss it and answer questions about it. So that would be one idea. Rather divide the Q&As into structured, we could do that. Okay, what is relatively difficult in getting profitable with trading ranges or trends and reversals? Well, everything the market does is going to have a difficulty factor to it. And that's just part of it, There's always there has to be a reason for the other side to take a trade. And because of that, there's always got to be, even in a trend or a trading range, nothing will ever look perfect, because if something looked perfect, then there's a greater risk of it would be a vacuum. So the one thing I'd recommend is trading really small. For me, I like the SPY. I think that's the greatest, not the greatest, but an ETF, whether it's the SPY or the Q, it's a great way to trade because you can trade one share. You can trade 1/50th of a micro. You could trade 1/5 or 1/10th of a micro and trade really small. And then you learn, big bear bars. I'm just going to trade 1 or 2 shares, put my stop up here. And worst case, if you lose, you're going to lose if you trade one share, you might lose 20 cents, if that, maybe less than that. I think that's a great way traders can trade starting out. And other than that, you just have to learn, tight trading range. One thing I would do is you have to understand why you're taking the trade. If I'm buying below, let's say I'm buying this close, 11. If I'm buying that close, I've got to understand why I'm buying it. And for me, I'm buying it because it's in a trading range. It's a tight trading range. Therefore, I don't want to see a breakout. And if I'm seeing alternating trend bars. So if 12 closes on its low and is a big bear bar, then 11 is wrong and I got to exit the trade. When scaling in, how do you decide when to hold for a profit or break even? Can you show a couple of examples? Yeah. So for me, first off, I always think about the market as for me, it doesn't matter if I'm scaling in or not scaling in. Risk is risk. And if I'm short right here, there's no difference between me being short here and holding all the way down here and me selling down here. It's the same trade. So I'm more willing to be aggressive on the first leg. So if this is a breakout and it shifted the market cycle, we've been at the moving average going sideways. Now we have a strong sell off. This sell off is strong enough for a second leg down and it's sell to close. Therefore, I'm more than willing to be short here and scale in. And I'm more willing to be a little bit aggressive about it. Here, second leg, okay to sell. However, eventually, once you start to get this 3, 4 big bear bars, I'm a lot more willing to take profits because I know the odds are it's going to go sideways. When I see this kind of bar and then a second leg down, I'm being very quick and I'm starting to lighten positions. Why? Because this is a trading range. We had this, I had some examples of this a couple weeks back. Here it is. Like right here. Big breakout, second leg down. I'm happy to sell that. But this is a warning that we're probably evolving into a channel. When I start to see this kind of price action in a bear trend, guess what? We're in a trading range. I don't know if the trading range is going to be the low or, this somewhere in here is the trading range. We don't know if the trading range is down here. Maybe it's a measured move down of the bars from here to here, but it's somewhere down here. There's going to be a bottom of a trading range. That's good for the bears, but tails, overlapping bars, climactic bar, another follow through bar, still going lower. So if you're selling, maybe you start taking profits. One of the ways you can do it is sell the close, put your stop maybe 1 or 2 points above the bar. And then bear breakout, stop maybe 1 or 2 points above. Another bar, put a stop 1 or 2 points above. But eventually, when I see a bull bar, especially after traders have been making money above bars and below bars, I'm definitely getting out of shorts. And if I'm not getting out of all my shorts, I'm getting out of a lot of shorts because the odds are this whole thing is going to become a trading range. And that's exactly what happened. But I would start with, if I'm selling, let's say, even someone that sold here, if they don't get out right here, they can scale in and then get out, break even. So traders do it all the time. They sell, they scale in, they get out, break even, or with the profit on their second. But I would always view the market from the same. And scaling in, it's a lot more, it's more valuable, obviously, in a trading range day. And for example, let me find, like over here on 7. I know I bought a 7 went up. I think I bought near the close, and I had a target, somewhere up here, not far, but up there. I bought more below the bar. And to me, it's the same trade. It doesn't matter if I was long from down here, if I had bought up here. I'm disappointed with the tail on 7. We have a pullback and an inside bar on 8. I'm probably going to get out pretty close somewhere up here. It doesn't matter if I scaled in or not. So let me look for some more questions. A lot of people trade options on the SPY. I don't at the moment. I suspect I will at some point, but right now, I'm not. So we have people saying they vote for structured topics based on votes. I really like that idea. Did not mean to do that. So let me see real quick here. Someone said that they're thinking of purchasing the books or the first book, and you can definitely do that. But I will say the videos is a faster approach, and both is helpful. But the videos are a lot more clear, and the books are harder to read. But I definitely, after I've seen the video course, I would definitely study the books. Okay, question. I'm trading for a prop firm and I'm limited to only two contracts at the moment. Doesn't matter if it's micros or mini or minis, no more than two contracts max. Have to be extra creative with scaling. Yeah, I would be very for one, based on what I know with prop firms, I think there's better prop firms out there as far as that'll let you trade more contracts. But really, I do it in terms of risk. So you can do it with just trading two contracts max, but I'd view it in terms of risk, and I would definitely trade micros and trade really small and just look for second legs. So you have a breakout on 7, just buy the close, buy more lower, get out, break even on your first, profit on your second. Do you have any predictions on when Al would have another face-to-face event? I don't know. I know they've talked about it, but I think it depends on how many people would want to go and where the location was. But if that is something that people want to do, then add it to the comments, some sort of vote on if you all would like some sort of face-to-face event, and I'm sure Al and everyone else would consider it. Someone said, taking me years to read the books. Yeah, the more you read the video course and the more familiar you are with the topic, then the easier the books become. So let's look at some more questions. Reading through the questions right now. Can you show us an example of the highest time frame you use to find a pattern? Example, what's the ideal length for a wedge bottom? Yeah, well, a few things. One, I'm always thinking about wedges as far as the highest time frame in the wedge, and the correction should be about half the amount of bars. So here, if this channel down, 1, 2, 3, let's say it's about 40 bars, we'll probably go sideways for about 40 bars. Here, we went sideways for about maybe 30 bars. But as far as higher time frames, one of the ways I look at it is, one of the ways I look at it is I often do it a lot with Forex, where you can often look at euro dollar. Here's a daily chart, and you have a bull bar and a doji, probably sellers above, probably buyers below. So what do you know about this bar right here? Here's an example. We know that right here, try 30-minute chart. You can see the market came really close. The high of this bar is basically 962, so 63 pips. And the low of this bar is 65 pips. So it came within 2 pips and bounced. That's one way. Other traders, what they'll do is they'll look at 60-minute charts. So here, buy climax, another one, stronger buy climax, but it's testing these highs, so it may fail. And obviously that was a report, so it'd been difficult to enter. But if a trader was aware of that, maybe they go to a smaller time frame and they look at a 5-minute chart. So if the market's going down, I'm not going to wait for, and I want to sell, I'm not going to wait for a 60-minute bar to close. I'll just go to a 5-minute chart, or if it's a, or if it's a 5-minute chart, I might go to a 1-minute chart. This is a good question. I'm currently going through the video course, chapter 13. Do you recommend trading a demo now, or should I wait until I finish the whole course? Well, the first thing would be, what's your goal? If your goal is to, if you want to really understand the trading course and all the, the Brooks price action terminology and actually how to use it, then you got to finish the videos. So, it's kind of, I get it. I think there's a difference between trading to gather your emotions and you've never traded before. That's good and all, but at some point, once you've really, I don't know, once you've taken a couple of hundred trades, then you're probably better off really, really studying. But that doesn't mean you're not trying to apply the information. But you definitely have to study and look at charts, and you probably have to trade as well. For me, I was doing all of that at the same time, and you know would would just studying for 2 or 3 years been the best thing? I don't know, maybe, but this is the path I chose. I figured this question was going to come up eventually. Would you worry about the future of retail traders, especially as artificial intelligence is becoming increasingly more prevalent in financial forecasting, hedging, risk management, portfolio management? So basically, will retail traders and traders trading at home ever be able to have an edge with artificial intelligence or AI? Well, that is an interesting question, and the first argument I would make, there's a few flaws in the artificial intelligence conversation. One is AI has to be given something, some sort of data set. So, or machine learning. If you think about machine learning, let's say machine learning over, it's always going to be learning about people, whether you're in marketing or anything. If you have an algorithm that's studying, I remember someone was explaining to me about Amazon. And Amazon, I don't remember exactly what it was, but what Amazon can do is, at least I think it was Amazon. If you look up, I don't know, let's say you look up a watch or, something at Best Buy, and then you go online and look up the price at Target, Amazon will, for some people, depending on the location, it will take their data from their computer and price it to give it maybe a couple of pennies better price. But it's still collecting data of people. And for AI to change trading, the traders would have to change. People would have to trade and think differently. So, in this conversation, I always go back to, what's the difference between a Ferrari, a gallon of milk, and Apple stock? And there's no difference. And you want to put buying a house in there. If the joke Al made was, if someone offered you one share of Apple for $1 billion to Warren Buffett, he wouldn't buy it because obviously it's not worth that. A gallon of milk, if a gallon of milk is, let's say it's $4 at a grocery store, and you go to a grocery store and someone's offering you $20 for a gallon of milk, what are you going to do? You're going to go to the other grocery store and buy it for $4. So that, bartering, trading, it's been ingrained in civilization since it began. And it's always going to be ingrained that way. The only difference between today is we can see it on charts. So it's still going to be the same patterns. I mean, you can go back to the Dow Jones, go back to charts as early as you can find. You're going to see the same patterns. If I go back to, I don't know, let's just look. There's a Dow Jones on a 10-minute chart. Big sell off, second leg, third leg, sell climax, sideways, buy climax, strong breakout, second leg likely. It doesn't matter. Daily chart, channel, sell climax, pause, second leg, maybe a third leg. We rallied, we tested near the breakout point. This is 2000. This is 2001. I mean, does it look any different? Here's a little bit harder to see, but maybe a weekly chart. Rallied, gap down, and then we channel. But anyways, it's the same. Okay, this is the last question. Then I'm going to wrap it up. But next Q&A, or next time we have one, I'm hoping to make it more of a structured discussion. So maybe in the so maybe we can send out a survey to everybody that's on the mailing list, and they can vote on topics that they would like to have discussed. So, question: how should we calculate the smallest scalp size in an instrument or time frame? For example, gold in a 10-minute time frame, or crude oil in a 5-minute time frame, or any other instrument time frame. Yeah. So, as far as time frame, the obvious question is, can you trade that time frame? So, let's go back to a 5-minute chart, and I'm just going to actually go back to today. Here's the E-mini. Here's a 1-minute chart. 1-minute chart sounds great and all, but every bar is 1 minute. So the question is, there's two things. One, can I keep up with that time frame? So if I'm trading a 5-minute chart, the first thing I have to ask is, am I fast enough to make decisions based on a 5-minute chart? The second thing I'm going to ask myself is minimum scalp size. What is the smallest scalp size that is okay? So if I'm trading, let's say 1 micro, I have a calculator up, and 1 micro, let's say the average cost of 1 micro is I think it's 1.2 for most people. So it's typically 25 cents for your broker to enter, 25 cents to exit, and then you got to pay 70 cents to the exchange. So that gets you $1.2 unless you're trading heavier volume. So for the average trader, they're going to pay $1.20 round trip. So if they go for 1 point in the micros, they're paying 24% in clearing cost and commission for that trade. So can you afford to lose 24% of your profit? And that's overhead. So if if you sell a widget at a store and 25% of the revenue from the widget is is a cost incurred, that's good. But or let me back up. If you get to keep 76% of the profit, that sounds really good. But that's also assuming, for trading, that's assuming you can consistently generate that 1 point scalp. So most traders should try and get at least 3 or 4 points. If $1.20 is the cost, 15 at least gets you under 10%. And the way I view it is 15 being a 3 point scalp. The way I view it is I typically want my transaction cost to be certainly under 10%, It'd be better if it's under 6%. That is ideal. And by the way, someone asked, how do you get on the mailing list? I'm pretty sure if you go to brookspriceaction.com, or let me back up, brookstradingcourse.com. So you go to here, type it in. Go to that website. And there should be a way to get on the mailing list. So if I go to the website, and then I will finish the example in just a second. Here's the website. Sign up, add me to the mailing list. I can click on the mailing list, enter my information, and you're on it. But anyways, I measure the average scalp size based on the cost of the trade. And a good example is Forex markets. So for Forex markets, if I go to a Forex market, dollar yen, 6-minute chart. Here we have, let's go to 5-minute. These bars are, this was today's price action. And these bars, as big as they are, they're 6 pips. So 6 pips, 5 pips. Usually 10 pips is kind of the minimum for a Forex trade. And even then, 10 pips is, you're still paying a commission of quite a bit. So because of the bid-ask spread and the commission, most traders, when they're trading Forex, would be a lot better off if they go for 20 pip scalps, for example. So the way I view that is, I want the average bar, for one, the time frame, I want the average bar to be the minimum scalp. So let's say a 60-minute chart. 60-minute chart, the smallest bar is 13 pips. Here, it's about 20 pips. So this chart works pretty well. If I go to the Canadian dollar, for example, these bars are going to be bigger. So this is about 23 pips. Smallest bar, 9 pips. That is an appropriate size. So I hope that answers your question. Yes, if you've already purchased the video course, you're on it. And by the way, just pay attention to on the video on the website, you'll get notifications as well. And also you can check the Discord as well. All right, so that is all the time I've got for today. Plus, my voice is getting a little bit tired. But in the future, be on the lookout. There might be a survey in a week or so that'll discuss more of it. But the plan would be some sort of discussion, perhaps over one of the videos for those that are, members of the course. Potentially, it'll be a discussion over one of the videos, some examples with charts, and then a Q&A of that discussion. But there will probably be a survey over maybe a list of topics to discuss that everyone can vote on. All right. Thanks everyone for watching, and I will talk to everybody soon.